In this video, you are going to learn how to read the market using multiple time frames, how to identify the higher time frame bias, and how to align your entries with the overall market direction. More importantly, you will understand why many trades fail even when the setup looks perfect, and how to avoid those mistakes by following a clear and structured approach used by professional traders. Hello traders, welcome back to the ComLucro channel. I will break this down step by step, showing you exactly how to combine timeframes, refine your entries, and build a trading process that is based on clarity instead of guesswork. If you enjoy this kind of content, make sure to like the video, subscribe, and turn on notifications so you do not miss what comes next. And let us know in the comments what topics you want us to cover next. You will also find links to our trusted partners in the description. When you use those links, you help support the channel and keep this content moving forward. Let's start with a practical example. Here we have a clear uptrend on the euro against the dollar on the 5-minute chart. We apply the Fibonacci retracement tool from the start to the end of the recent impulse move and place a buy limit at the golden zone. This means that if price pulls back to this level, it is considered a deep enough retracement for us to enter the market and take advantage of the uptrend. However, price suddenly drops and we end up losing the trade. To understand why, we zoom out to the 1-hour chart and realize that even though the lower time frame showed a bullish move, the overall trend on the higher time frame was actually bearish. What looked like an uptrend on the 5-minute chart was simply a corrective move within a larger downtrend. Once price resumed its higher time frame direction, it led directly to our loss. In another example, we see a clear downtrend on the 1-hour chart. A fair value gap above a liquidity zone appears to offer a strong shorting opportunity, so we prepare the trade. At first, price reacts slightly, but it eventually reaches our stop loss again, leaving us wondering what went wrong. By zooming out to the daily chart, we notice that price had just reached a significant support zone, and we entered a sell position right after that. This means we were trading against a potential higher time frame reversal, which likely caused the setup to fail. So how can we avoid this kind of mistake? It does not require starting from the monthly time frame and analyzing all the way down to the 5-minute chart. In fact, using more than 3 time frames usually adds unnecessary noise. Anything beyond that is either too broad or too detailed to provide meaningful context. There are 3 types of time frames we work with. First, we have the main time frame, where most of our analysis takes place. This includes identifying market direction and structure, spotting liquidity zones and imbalances, and marking the trading zone. If confirmation is needed and we are not fully confident in taking the trade, we can then zoom into a lower time frame to look for additional signals. For example, if we have marked a demand zone on the 1-hour chart but want extra validation, we can switch to the 5-minute chart to see how price reacts to that zone. Price action signals such as long wick rejections or a double bottom pattern can serve as strong confirmation that the zone is being respected. These lower time frame clues can give us more confidence to take a long entry. At the same time, it is also important to check the higher time frame to get a clearer view of the bigger picture and make sure our analysis aligns with the overall market direction. For example, an ideal trading scenario is when both the higher and lower time frames are showing an uptrend. Another strong setup is when a market structure shift on the lower time frame happens right at a key zone identified on the higher time frame. This brings us to the main topic of today's video, which is how to analyze the higher time frame to determine the daily bias. But before that, why do we even need to determine the daily bias, and why does the higher time frame matter? The first reason is that higher time frame levels are more important. A minor reaction at a key level on the higher time frame can lead to a significant trend change on the lower time frames. That is why, before placing any trade, we should always check how much room price has before reaching a higher time frame supply or demand zone. This helps us set more accurate targets and stop losses, and it also helps us avoid entering trades that are more likely to fail. For example, here on the US dollar against the Japanese yen 1-hour chart, we can see a strong uptrend. At first glance, it looks like a promising bullish market for entering a long trade. However, price fails to create a new higher high and rejects the same level twice before reversing. Now, if we zoom out to the daily time frame, we can clearly see that this area has recently acted as a strong support and resistance level. So despite the strong bullish momentum on the 1-hour chart, the market still reversed. This shows why higher time frame key levels are more important. They give us a stronger indication of where major reactions are likely to happen, because they reflect longer-term trends and more stable areas of interest. The second reason is identifying the macro trend. The best trading setups appear when the higher time frame and lower time frame are aligned. Imagine entering a trade on the 15-minute chart just because you see a bearish structure forming, but without checking the higher time frame, you miss the fact that this downtrend may simply be a corrective move inside a larger bullish trend. In that case, price can reverse at any moment and continue in the broader bullish direction. On the other hand, when the lower time frame setup aligns with the higher time frame trend, you're trading with the overall momentum. That greatly increases the probability of success because you're no longer fighting the dominant direction of the market. The third reason is filtering noise and fake breakouts. Lower time frames often contain a lot of market noise, unpredictable price swings, and false breakouts that can easily trap traders in bad positions. By identifying the higher time frame bias first, we gain more clarity on the dominant market direction. That helps us filter out setups that go against the broader trend and avoid getting caught in fake breakouts that happen during short-term corrections or consolidation phases. For example, on a 5-minute chart, you might see what looks like a breakout below a recent low. But if the higher time frame trend is bullish, that breakout may simply be a liquidity grab before price reverses back to the upside. Without the higher time frame perspective, that can easily lead to unnecessary losses. Now that you understand why higher time frames are so important, let me show you how to find the higher time frame bias on a chart and explain step by step which concepts we use. This is a general trading plan that uses multiple time frames based on the main ones most traders focus on when analyzing charts. However, some traders make the mistake of starting from the monthly chart and going all the way down to the 1-minute chart, thinking it will lead to a perfect trade. In reality, this often creates confusion. The chart becomes filled with too much information and noise, making it harder to make clear decisions. That is why it is better to use a maximum of 3 time frames. For example, if your main analysis is on the 1-hour chart, you can use the 4-hour and daily charts to support your setup. More importantly, higher time frames should only be used for simple concepts, such as marking key levels and identifying the overall market direction. There is no need to analyze every single time frame. Using too many charts can lead to mixed signals and unnecessary complexity. Keeping just 2 higher time frames above your main one is usually enough to get a clear view without overcomplicating the process. So in this part of the video, let's go through some real chart examples to show how we combine multiple time frames, from identifying the higher time frame bias to finding confirmation and executing the trade. For this analysis, we will use the 1-hour chart as the main time frame, the 4-hour and daily charts as higher time frames, and the 5-minute chart for confirmation and entry if needed. So here we have euro against the dollar on the 1-hour chart. The structure is clearly bullish, with price consistently breaking above previous highs, which is exactly what we want to see. If the market looks unclear or choppy, it is better to switch to another pair or simply step away and wait for a better setup. There is no need to trade every day, and taking more trades does not necessarily mean making more profit. Since the 1-hour chart suggests an uptrend, we are only interested in buying this pair. However, we cannot enter the market immediately because price has moved up quickly and may correct at any moment. Because of that, we need to wait for a pullback to enter at a better price. Now the question becomes, where is the optimal entry zone? To answer that, let me show you how professional traders define optimal entries. OTE stands for Optimal Trade Entry. It refers to a specific Fibonacci retracement zone that aligns with discount for long trade entries and with premium for short trade entries. The idea behind OTE is to refine entry timing by focusing on areas where price is considered optimally priced within a range. This specific Fibonacci retracement zone runs from the 0.618 level to the 0.786 level. The midpoint of this zone, which is the 0.702 level, is also highlighted. In this illustration, you can see an example of an OTE for a long trade. Notice how this zone falls entirely within the discount zone. It is important to observe how price action reacts to all 3 levels of the OTE. with particular attention to the 0.702 retracement level. In the next illustration, you can see an OTE for a short trade. In this case, the zone falls within the premium zone. The same principle applies here. It's important to observe how price interacts with each of the three levels of the OTE, especially the midpoint retracement level, just as we do when analyzing an OTE for a long trade. Now that you understand how to define the optimal entry zone, let's apply that directly to our current setup. If we focus on the most recent impulse, we can see that it has created a fair value gap. From there, we mark manually on the chart the candle that initiated this move as our order block zone, since there is a higher probability of a reaction if price returns to this area. At the same time, this area aligns with the OTE zone, which gives us a clear confluence for a potential entry. With this in place, the plan is simple. We wait for price to pull back into this zone and look for long opportunities. Once price reaches our trading zone, the next step is to check the higher time frame and see if our analysis aligns with the bigger picture. So let's switch to the 4-hour chart. We want to keep things simple, so on the higher time frame, we focus only on identifying the overall direction and the key structure levels. Here, we can see that price was previously in a long-term downtrend, but that condition has now changed. Price has broken above previous trend lines and key supply levels, showing strong bullish momentum. In other words, the 4-hour chart is also confirming a bullish market and an ongoing uptrend. Now let's mark manually on the chart the key zones where price has recently reacted near the current level. We can identify two important areas that have acted as both support and resistance multiple times. Above that, we can also see a strong level that has rejected price twice and acted as a major turning point for the 4-hour structure. This makes it a very significant zone, and price is likely to react again when it reaches that area. This means that if we take a long position, our higher time frame target would be that upper resistance zone. For now, there is still enough room for price to move before reaching it. With all of this in mind, the higher time frame analysis aligns perfectly with what we saw on the lower time frame. So, let's switch back to the 1-hour chart. Since the higher time frame confirms a bullish trend, it makes sense to consider a buy position at the order block, with the stop loss placed just below it. However, we can refine the entry further by moving down to a lower time frame and looking for a reaction at the order block. First, wait for price to approach the zone, then switch to the 5-minute chart. At this stage, the only thing we need to see is a clear reaction from that area. This could be a simple long wick rejection, which is enough to confirm interest. In that case, we enter the trade at the close of the rejection candle and place the stop loss below the wick. At the same time, we avoid placing the stop loss too tight. The idea is to give the trade enough room to move and avoid getting stopped out by normal market fluctuations. By combining multiple time frames, we align the overall trend with a precise entry point, increasing the probability of success and improving confidence in the setup. Now let's go through another example on the pound against the dollar on the 1-hour chart. Here we can clearly see a downtrend. The most recent impulse has created an imbalance and also formed equal highs, which means liquidity has built up above that level. From there, we can mark manually on the chart the small consolidation before the imbalance as a supply zone. As traders, we understand that if price retraces above the equal highs, takes the buy-side liquidity, and reaches the supply zone, it can create a strong short opportunity. Based on that idea, we can place a sell limit at the zone and position the stop loss above it. But before executing the trade, we need to check the higher time frame and understand the broader context. Looking at the 4-hour chart, we can see that price has just tapped into a strong support area. This level has acted as a turning point multiple times, and the reactions from this zone have been strong. All of these factors confirm that this is a key higher time frame level. So now that price is testing this area again, there is a higher probability of a rejection to the upside. This means the market has the potential to move higher, even though the 1-hour chart is showing bearish pressure. If we go back to the 1-hour chart, we can see that taking the short setup in this context would be risky. And if we play price forward, we can see how strongly price reacted from the higher time frame level, pushing above our stop loss and eventually reversing. This is a clear example of why we should always check higher time frame zones before entering a trade based only on a lower time frame setup. By combining multiple time frames in your analysis, you avoid taking trades that look perfect but go against the bigger market move. And if you want to go deeper into execution, we are now going to play a short clip from another video linked in the card. In that video, I break down 3 powerful scalping trading strategies for the 1-minute and 5-minute charts, showing how professional traders use higher time frame analysis, liquidity sweeps, and confirmation-based entries. Pay attention to how the entries are refined, because this is where analysis turns into execution. To apply this correctly, you need to work with 2 time frames. Start with a higher time frame to analyze the overall market condition. On this time frame, you should mark manually on the chart the liquidity sweep, the break of structure, and the order block connected to that move. Then, you zoom in to a lower time frame to follow the higher time frame delivery, and watch for reversal or confirmation signals. At that stage, you wait for your entry model to appear before opening a position. Now let's go step by step and see exactly how this setup plays out. To begin, you need to identify a key liquidity sweep, or liquidity grab, together with a break of structure on the higher time frame. Everything here should be marked manually on the chart. For this video, the focus is on understanding the logic clearly and identifying each part of the setup step by step. In this bullish example on the higher time frame, the first thing you want to find is a bullish liquidity sweep, or liquidity grab. In simple terms, you want to see price take out a key level, reverse immediately, and then confirm that reversal with a break of structure. From there, mark the setup manually on the chart. In the bullish case, this means spotting the moment price sweeps below a recent key swing low, shows a strong rejection to the upside, and then delivers a bullish break of structure. After that, the next step is to mark the order block that initiated both the liquidity grab and the break of structure. That area becomes your higher time frame point of interest. Please also remember that the mission of the ComLucro channel is simple. We focus on giving traders clarity, confidence, and structure, so market decisions are made with discipline and intention. On this channel, you will find complete courses built as a true trading masterclass. We teach market structure, higher time frame trading, and supply and demand, always focused on understanding price behavior and executing with a professional mindset. We also go deep into trading psychology, risk management, and consistency, because trading is not just about charts. It is about mindset, discipline, and structured execution over time. There are no shortcuts. Real progress comes from continuous learning and practice. Our main courses include Smart Money Concepts, Technical Analysis for Day Traders, Trading Psychology, and the Wyckoff Method course. Alongside our courses, we share lessons and insights from some of the most respected names in trading, including professionals like David Paul, Alexander Elder, Tom Hugard, Mark Douglas, Al Brooks, and Larry Williams, whose experience has shaped how traders understand markets today. So, if this video helped you gain more clarity, leave a like. It helps this content reach other traders who are on the same journey. Make sure to subscribe and turn on notifications so you don't miss our latest lessons and insights. Now, I would really like to hear from you. Which concept in this video made the biggest difference for you? What topic would you like us to cover next? Leave a comment below and let us know. If you want to go deeper with exclusive content, early access to videos, and additional tools to support your development, consider joining the ComLucro Trader community right here on YouTube. It is a simple way to support the channel and a smart investment in your own growth as a trader. Thanks for watching, and I will see you in the next video.